In today's market update, I'm going to be speaking about market timing and the important difference between trying to forecast the future on the one hand and on the other hand applying the insights that a Hurst Cycles analysis gives us to making trading and investing decisions. My name is David Hickson. It is the 14th of March 2022, and before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. Let's start, as we did last week, with a look at gold. And I received several amusing emails about gold last week. And the previous two market updates, I think I've been speaking about the fact that I am expecting gold to rise up into an 18-month cycle peak. And I've been presenting this analysis. I haven't been discussing the troughs. So in fact, let's hide the troughs so that we're only really considering the peak analysis in gold. And of course, the important thing is that there was an important peak in the middle of 2020. I think that was in August of 2020. And I've been speaking about the fact that an 18-month cycle peak is approaching, or that gold is in the process of forming an 18-month cycle peak. And I've realized I need to be quite careful with the words that I use, because when gold forged up to new prices last week, I received some surprised emails saying if gold is moving into or is forming an 18-month cycle peak, then why is it moving up so much? And so that's why I need to be quite careful with my choice of words. Of course, the important point here is that when a market forms a peak, it will of course move up into that peak. So it was not a surprise that gold was moving up. That was not the surprise at all. Similarly, when a market is forming a trough, as we will look at in a moment with the stock markets, the S&P 500 and the Nasdaq, when price is forming a trough, then of course it must move down into that trough. The fact that I am speaking about gold forming a peak does not mean that we should immediately rush out and sell gold. And that's why today's video is really about market timing. There is a misconception, I believe, about what we do with the information that a Hurst Cycles analysis provides us with. Some people expect that because we are anticipating a peak, as we are here, and here is the very jagged nest of highs indicating the period of time in which the peak is expected to form. Because we are expecting a peak, we do not immediately go out and sell gold, because we do not look forward to the next price move until the current price move is complete. So the important thing is here, when price is approaching a peak or when it is forming a peak, we expect price to move up. Okay, and eventually it will form a peak. Market timing sometimes has the sort of bad record of expecting price to reverse at a particular time and assuming that we must immediately reverse our positions at the time that we are expecting the price reversal to happen. So that is not what we do. Because we are expecting a peak, we would of course expect price to rise into the peak, and then we need to wait for confirmation that the peak has formed before we start saying, okay, well now price is falling away from the peak. And that's a really important thing. I mentioned it in last week's market update video. And so how do we confirm that peak has formed? Well, there are various methods. We use our Hurst Cycles tools. Of course, that's my favorite method, and my favorite tool is the FLD, as you probably know, and I've pointed out these FLDs in previous market updates about gold. We have a 20-day FLD, then a 40-day FLD, then an 80-day FLD, and of course there are many other FLDs. I could display them. I might do that later when we're looking at the stock markets. These FLDs are forming what is called a cascade pattern. This is a cascade pattern that is cascading upwards. A cascade pattern is when these FLDs all line up like that, and particularly when they get really close together. that forms a cascade pattern. And as price starts crossing down below the FLDs, it will generate a target as it crosses each FLD. And that target, if it carries beyond the next FLD, makes that a cascade pattern. And it implies that, of course, price will cross down below one, and then the other, and then the third, and so forth, and we will see a strong move down. That's the implication in terms of what we expect. But the point that I'm trying to make here is that we do not have confirmation that a peak has formed until price actually crosses down below the FLD. Until price crosses down below the FLD, and we'll take a look at a really good example of what's happening in stock markets at the moment. Until price crosses below the FLD, we do not have confirmation that the peak has formed. And I mentioned this in last week's market update video, where I pointed out that price had failed to cross below the FLD following this spike upwards, and because of that failure, the peak was not yet confirmed. Really important. So until a peak is confirmed, we expect price to move up into that peak. It is possible that the 18-month cycle peak that we were expecting formed on Tuesday of last week at that high price over there. That is absolutely possible, but it is not yet confirmed because price has not crossed below the 20-day FLD. I'm using the 20-day FLD here because it's a very useful FLD to track price movements and the cycles in terms of the sort of time frame that we're looking at in these market update videos. Of course, we could use a shorter FLD, a 10-day FLD and a 5-day FLD, and I could display those FLDs. Let me do that, and you will see that the shorter FLDs have, of course, been crossed by price. Now, when these shorter FLDs are crossed by price, that tells us that the shorter cycle has a confirmed peak in place. It does not tell us that the 18-month cycle has a confirmed peak. So what sort of FLD do we need to cross in order to confirm that the 18-month cycle peak is in place? Well, in fact, we would need the 18-month cycle FLD to be crossed. But because of the principle of synchronicity, and because of the fact that I believe that the peaks are synchronized in gold, which is something that I've mentioned in previous market update videos. I'm not going to dwell on it too much here, but you will know that Hurst discovered these cycles when he was studying stock markets, and he discovered that stock market price movements are influenced by cycles that are synchronized at their troughs. There is a good deal of evidence that gold, on the other hand, is influenced by cycles that are synchronized at their peaks. And so we expect to find that the peaks are synchronized, the cycles of the peaks of the cycles are synchronized. And therefore we can apply some logical reasoning to the fact that when a particular cycle FLD is crossed to the downside, although that only provides us with confirmation that that particular cycle has formed a peak, it will, by the principle of synchronicity, also provide us with information that it is likely that a longer cycle peak has formed. Without getting into too much technical detail here, I will tell you that I believe that once the 20-day cycle FLD has been crossed to the downside, I will start assuming that the 18-month cycle peak has formed in the markets. I say start assuming because that is the first part of the process. So to get back to the fact that we're talking about market timing, when you are expecting a peak, you don't immediately rush out and start selling the instrument that is expecting to form a peak, because price must rise into that peak. Similarly, when price crosses the FLD, there are some traders, and under some circumstances I am one of those traders, who will immediately jump into a short trade. But in this particular situation, I will not. I need further information and further details before I will enter into a short trade. So the confirmation by price crossing the FLD, which I should point out, it has still not yet done in gold. And let's just zoom in again and look at that in detail and clear these shorter FLDs. So I am watching these FLDs closely. When price crosses the FLD, that would be confirmation for me. But as somebody who is working with market timing to time their trades, it would probably not be a good idea to jump in this circumstance as price crosses the FLD, because we need something else to happen first. And in order to demonstrate that, we're going to move on and take a look at the stock markets, and we'll start with the S&P 500. So here is the S&P 500 before we start discussing the market timing aspect of what's happening in the S&P 500. Let's take a look at the bigger picture. And as you know from previous market update videos, for a long time I have considered the March of 2020 a very important trough, probably 54-month magnitude. But as discussed in last week's market update, it is just possible, and I mentioned it in a few market updates prior to that, it is just possible that the more important trough that we're looking at here is the December of 2018 trough. And the reason for that is because of the fact that this cycle seems to have turned bearish. And I've discussed this in previous market updates, so I'm not going to dwell on it. There was a trough in early October, which I believe has a very high likelihood of turning out to be the 18-month cycle trough. We'll take a look at a moment in an alternate, which is that the recent trough that has formed, or that is still busy forming, was in fact the trough of the 18-month cycle. So this analysis has the 18-month cycle trough here in October. And if we take a look at the semicircles, then we will understand why there is a bit of an anomaly. Let's display those semicircles. There we go. The reason there is a bit of an anomaly with this cycle turning quite so bearish in the first 20-week wave is because this is only the first 18-month cycle in a 54-month cycle, and this is the second one, and there is the third one. And of course we would expect a very bullish 18-month cycle for the first one. The second 18-month cycle will be slightly less bullish, but it shouldn't really be turning bearish quite so soon. So that is the anomaly that I have discussed in previous market update videos. And when we take a look at the Nasdaq, you will see that the December 2018 trough provides us with an interesting alternative, and I discussed that in last week's market update, so I'm not going to dwell on it here. In terms of market timing, what I would like to do is zoom in on this analysis, and let's discuss what is actually possibly happening here. First of all, here is the 18-month cycle trough that formed in October of last year, and if we count the number of bars that have elapsed since then, there have been 164 bars or days. The average length of a 20-week cycle, you should know by now, is 136 days. So if we measure 136 days for that average length 20-week cycle, that places us in the middle of February. As you can see, Sentient Trader has positioned some hollow diamonds. They are hollow because they are not yet confirmed for the 20-week cycle trough, having formed here at the end of February. I discussed this in last week's market update. But in terms of understanding our approach to market timing and how we work with this information, again, as price is coming down into a suspected trough, we of course expect price to move down. So that's the first thing. So it's no big surprise that price has moved down. Is this trough confirmed? As discussed in last week's market update, it is not yet confirmed, which is why I have been drawing question marks around that trough. It is possible that the 20-week cycle trough formed over there, but it is not yet confirmed. So how do we confirm a trough? Again, I will use the 20-day FLD in order to confirm the position of this trough. And let's just zoom in and take a look at what's happening with this 20-day FLD. I mentioned when we were looking at gold that the first thing that I expect to happen in order to confirm a trough is for price to cross above the 20-day FLD. Now you can see that in last week's market action, price was fairly firmly below the 20-day FLD, and it did sort of poke its head above the 20-day FLD 2 weeks ago, but as discussed in last week's market update, it was not a convincing cross above the 20-day FLD. And so this trough is still not confirmed. It is possible that it has occurred, but it is not confirmed in my opinion. Now, if you go back and take a look at market updates, just as an exercise for understanding how I use this approach to actually timing the markets and to making sensible trades on the basis of some market timing, you will see that I discussed the possibility way back probably in the last week of January, perhaps in the first week of February, the possibility that this trough that we were expecting formed over here on the 24th of January, because there was a fairly strong move down. It would have been an early cycle trough, as discussed at the time in those market update videos. I'd encourage you to take a look at them, because there's a lot of information to be gathered from understanding how we are tracking these markets as they unfold over time, and that's what I hope you can gather from taking a look at that video. And of course, price did cross above the 20-day FLD, so that provided us with some confirmation that the 20-week cycle trough might have formed. But as discussed in the market update videos at that time, I very seldom jump into a trade purely on the basis that the 20-day FLD has been crossed. I consider that the first step in the process to actually entering into trades on the basis of the market timing information that we can gather from Hurst Cycles. So, of course, the first step is that some kind of a possible trough does form in the markets, and then we need to have the confirmation. So let me actually renumber this. Let me just remove that and let me renumber this. The first step is, of course, some kind of a potential trough forming when we expect it. The second step is a confirmation of that trough by price crossing over above a suitable FLD. And as I mentioned, there are multiple FLDs to consider, and so each situation is slightly different. The 20-day FLD is a good, reliable one, so I'm going to keep working with the 20-day FLD in this situation. The next thing that we expect is for the target that is generated by that price cross to be achieved. So I'll call that step number 3. Is the price target achieved? In this case, it was not. If the price target is not achieved, often it's good enough if price gets sort of near to that price target. I would have been expecting price to come up to about 46.50 to satisfy condition number 3 in terms of timing an entry into this market. If the target is not achieved, then that starts raising question marks. Okay, we begin to question again the phasing of this trough because the target has not been achieved. The next step, and the really important step, is that then price should come back and find support at the level of the FLD that we're considering. In this case, it's the 20-day FLD. Now, when does price come down and find support at the level of the 20-day FLD? You should know by now that it should do that at about the time that the 20-day FLD, the 20-day cycle, forms a trough following the trough that we are considering entering our trade on the basis of. In this case, it's a 20-day cycle trough, 20-week cycle trough, I beg your pardon. We're going to take a look at that at a moment in terms of what's happening right now in this market. But as you can see, as price came down to the 20-day FLD, it by no means found any support at the level of that FLD. You can see that over there. So here at step number 4, this was an absolute non-confirmation of that trough. It is still possible at that time, it would have still been possible that the trough formed there, but that the market was turning bearish and that it was going to find support at a level below the 20-day FLD. That does sometimes happen. When that happens, it gives us information that there is some extra bearishness in the markets. But as you can see, price dropped down to a new low, thereby telling us that in fact this trough over here was certainly not the trough that we had been expecting. or I shouldn't say certainly, but was probably not the trough that we had been expecting. So let's take a look at exactly that same sequence in terms of what's happening now in the S&P 500 and also in the Nasdaq. We'll look at it in the Nasdaq. We have a potential trough forming when we were expecting it. That's step number one. Step number two, we would expect it to cross above the FLD. As mentioned, it didn't really succeed in doing that. You might have argued on Thursday of 2 weeks ago that prices crossed above the FLD, and certainly we were looking at that and considering it, but it actually failed to convincingly cross above the FLD by dropping down on the very next day. The third part of this process would be price achieving its target to the upside, which it certainly failed to do. So I'll put a question mark on 2 and a cross on 3 because it certainly failed to achieve its target. And then does it find support at the level of the 20-day FLD, which was point number 4? Again, it hasn't. And so we do not have clear, confident confirmation that this trough that we were expecting has formed, and therefore we would not now be jumping into long trades on the S&P 500 because there are too many things that are simply not making sense in terms of the formation of that trough. So what does this mean in terms of what's happening in the markets at the moment? Is it possible that the 20-week cycle trough has formed in the markets? Yes, it is certainly possible. As you can see, Century Trader has positioned a hollow diamond there, meaning that it is possible that the 20-week cycle trough has formed in the markets. So what's going on in that case? Well, following a trough of the 20-week cycle, we would expect the market to be fairly bullish and to get some bullish trading opportunities. Our sequence, as I've just mentioned, in terms of confirming the trough and then making sensible trading or investing decisions on the basis of that, has failed. So we do not have the confirmation of all of those things that we were looking for, and so we do not have a clear signal to get into a long trade in this market at the moment. Is it possible that the 20-week cycle trough is formed? Yes, it is, and it is also possible that this is the 20-day cycle trough that has formed over here, but it has formed below the 20-day FLD. When the 20-day cycle trough forms below the 20-day cycle FLD, that is a bearish signal. So we're not jumping into enthusiastic long trades on the basis of timing this potential trough forming in the markets, because there are just too many things, too many bearish warnings. We've got all these things that are not making sense in terms of timing this trough, and the fact that price has dropped down below the 20-day FLD is issuing some bearish warnings. And so even though we might have a trough that has formed in the markets, we're still not jumping into those long trades because we need to see evidence that the market is turning bullish before we're interested in getting into any kind of bullish trades or long trades. So let's take a look now at the Nasdaq, because the Nasdaq provides an interesting explanation, as I mentioned a moment ago, in terms of why the cycles might now be turning bearish or turning negative. Whether this explanation makes sense in the other markets, as discussed in last week's market update, it doesn't transfer very clearly to the other markets. And so whether this possible explanation about bearishness in the markets is going to translate into the other markets, we don't know yet. But nevertheless, the important point about market timing, the point that I keep trying to make in this video, is that because we're not seeing the bullishness in the S&P 500, I am not yet turning bullish in that market, even if this potential bearish explanation doesn't make any sense in that market. So what is the potential bearish explanation that the S&P 500 offers? Well, as discussed in previous market update videos, because we had the lower price in December of 2018, the 54-month cycle trough gets positioned fairly nicely in December of 2018, which means that the first 18-month cycle elapsed into the March 2020 low. So that was the first 18-month cycle. The second 18-month cycle potentially formed an 18-month cycle trough over here in October, or there is the alternate that the 18-month cycle trough is only forming now, and we should take a very quick look at that in a moment, just to understand what's happening there. But the important thing about things turning bearish now is that we are in the third 18-month cycle, which started over here probably in October of last year. And this third 18-month cycle should be the least bullish and the most bearish of all of these three cycles, so that we can bring price down into the 54-month cycle trough that is expected early next year. So as mentioned, this would give us an explanation for why this cycle is turning bearish. And if we zoom in, we have exactly the same situation as we have in the S&P 500 in terms of actually confirming that this 20-week cycle trough has formed. And we go through the same three steps in terms of confirming it. And here we can see, I'm just showing this because, of course, the next important trough, if the 20-week cycle trough has formed, the next important trough is the 40-week cycle trough, which we are expecting in late June, perhaps sometime in July. That's the next trough that we need to be focusing on if the 20-week cycle trough is behind us. But if we zoom in here again, we have exactly the same situation as in the S&P 500 in terms of price not really confirming this 20-week cycle trough. We do get a trough forming at about the time that we were expecting it, 136 days, or roughly 136 days following the previous 18-month cycle trough. And then we did get price coming up to the 20-day FLD. Some people might argue it crossed above it. It was not very convincing, so I put a question mark on that one. It certainly did not achieve its target at all. Its target would have been somewhere up at that level in terms of price crossing above the 20-day FLD. So it failed to achieve its target, and when it came back to the 20-day FLD, it failed to find support. So number 4 is also a failure. So therefore, we do not have good clear signals in terms of entering into a long trade as a result of the potential formation of the 20-week cycle trough forming now, exactly as is the situation in the S&P 500. And so to zoom out again, the important thing in terms of applying our Hurst Cycles analysis is we have failed to identify a good opportunity to enter into a long trade, which might mean that there simply is not a good long trading opportunity present in the markets at the moment. Why is that? Well, as you can see, the markets have been turning bearish. We have a potential reason for why those markets might be turning bearish in terms of the fact that we could be in the third 18-month cycle. But nevertheless, we need to let the market action dictate our trading actions. And when the market action is bearish, or certainly not confirming the potential for a long trading opportunity, we do not jump into that long trading because there simply isn't one available to us. And we need to be thinking about what's going to be happening in terms of the next 20-week cycle, which, as I mentioned, will bring price down into a 40-week cycle trough, probably sometime here in July. So although we are expecting an M-shape for the next 20-week cycle, we are not getting the long trading opportunity that we would normally expect. Let's quickly take a look at the alternative analysis here for the Nasdaq, which places the 18-month cycle trough as happening now. And as you can see, I have actually pinned it there just to see what it does in terms of the analysis. So we have the same situation. Potentially the 18-month cycle trough formed over there, or perhaps it still lies just ahead of us. but the important thing is that we do not have a long trading opportunity yet. Now let's quickly round this discussion off by taking a look at some composite model lines. These composite model lines I've discussed in many of previous market update videos. It takes the information from the cycle analysis and recomposes it, which is why it's called a composite model line, and it shows us in the past what the cycle information is telling us in terms of the analysis at the foot of the chart, and it gives us an idea of what to expect if the cycle analysis is correct and if these cycles keep doing what they're doing at the moment in terms of their wavelengths and their amplitudes. If the 18-month cycle trough formed a few weeks ago, a couple of weeks ago, or if it's forming at around about this time, then of course we would expect the market to bounce out, come down into an 80-day cycle trough, and then come up to a higher peak and then move down again. That's the M shape that we're looking at. That would be our expectation if this is the correct analysis. I don't think this is the correct analysis, and so we should probably focus our attention on the other one, which we're going to do in a moment. But the important thing is that we don't program our trades ahead of time. You know, we don't say, well, the orange line, the composite model line, is going up, so therefore we must buy. We certainly don't do that. That's really the point that I'm trying to make in this video, is that we wait for market action to confirm our expectations and then we enter into our trades. Let's take a look at the composite model line in the other analysis. Here it is, and there you can see very clearly in the composite model line these M shapes that I've been drawing. That's the M shape for the first 20-week cycle following the potential 18-month cycle trough at the beginning of October. Look at this next M shape. You can see that it is coming up here and coming down into the 40-week cycle trough, as I mentioned a moment ago, in July. Okay, so that is that M shape. Now that M shape is indicating some bullish action, and that's because of the information contained in this analysis. So is that what's going to happen? Well, we're certainly not seeing it happen at the moment, are we? And as I have mentioned, there have been many bearish cracks. And so even though the 20-week cycle trough might have formed, I believe that the bearishness in this market is at the moment certainly overpowering the shorter cycles that we're looking at here. What I mean is that the much longer cycles are overpowering it, and there seems to be the bearish pressure that is probably going to force this M shape on the right hand side over here into a more bearish shape, indicating that the 40-week cycle trough expected in July could well occur at a lower level than the trough that is forming at the moment. Let's go back to gold for a moment and take a look at the composite model line in gold. Let's zoom out and apply the composite model line. So the composite model line in gold, as I think you can see, matches a good deal better than it is in the S&P 500 and the Nasdaq at the moment. That simply indicates that the cycle analysis provides us with a slightly more accurate picture in terms of what has been happening in the markets. But as you can see, this composite model line is indicating that the 18-month cycle peak is certainly expected round about now, and we are looking at the price of gold moving down and away from that 18-month cycle peak. But of course, the important point I'm making in today's video is that we need to wait for confirmation that the peak has formed and then make our sensible trading decisions on the basis of that. I do hope that you found this market update useful and interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.